Okay, Williams Sonoma, WSM. So you can all go to website and you can see they have actually 8 brands under this name, and there are different brands, different products, and all of them, they have retail offline and retail online. So it's kind of a good brand. Some of them performing better than others, but in general, if you go, you buy quite a lot of products. So a significant choice of products which WSM has. Okay, we can see here kitchen equipment, chairs, sofas, tables, etc., etc. Now, we're more interested in fundamental analysis. And do you see clearly all the numbers? Like, because I am going to show you them. Okay, perfect. Okay, first of all, timeliness. We can see that timeliness for that particular company, its value line kind of index, which shows how company is going to perform compared with companies which value line analyzes. So we can see it's 3, it means average. Okay, it's average universe. And safety, it's also 3, average as any other company, not better, not worse. Beta, they believe that this company performs as a market. But when we look at the projections within the next 3 to 5 years, we can see that they expect that company will be traded between $75 and $115. So somewhere here. And at the moment, the price is 50, but in reality, it's 57. Whatever I was doing screenshot, 57, 75 or $58. So it's $2 even below that price. Okay, 4% less. So, and if it is true, if value line is correct, it means that your profit, if you just buy the shares, it would be somewhere in between 15 to 27% annually. Okay, until it reaches that point. Okay, if it goes to $115, your profit would be 27% annual. If to 75, about 15%. So it's pretty good already. Now we're going to compare our results after analysis with value line results. Okay, and compare like if they're correct or not, or if we are correct or not. Okay, so first of all, always look at value line, 2 parts. First part is like per share analysis, and then per company. Okay, and we're going to look at this. So first, if we look from 2000, we see sales level. So first sales per share, and we can see 16, 18, 20, 23, 27, 30, 33, 37. And then in 2008, it started dropping down. So, and we can see that it's dropped at the lowest point here, and then it started growing again. So we can see that from its maximum in 2007, $37, it went to $29. So we can see what? About 20% drop in their revenue, in the sales level. So despite 2000, it was heavy period, especially for hardline industries we discussed before. They still managed to keep their sales up. Only 20% dropped in their sales level. Now, and then sales levels start growing up. So you can see 33, 37, 41, 46, 51, 55, 58, and 62. Okay, they are planning 2017. This report, because last report for the last quarter wasn't issued yet, it's going to be 15th of March, right? So it's in about a month. Okay, so we have to keep an eye, and then we'll have final figures. Now, I always compare growth per share with growth in company as a whole, because quite often company might buy in shares, and it is the case here. What might happen that sales were dropping per company, but per share it will be growing up. So, and we can see that common shares outstanding here, we can see that it was the maximum point here in 2004, 115 million, and then they start buying it back. Okay, and we can see 97, 94, 91, 89. In this year, it's going to be left only 87 million of shares. So they can see that buying it back. Now let's have a look at sales as a whole. So what can we see within last, let's say, after this recession? So 3.1 billion, 3.5 billion, 3.7, 4 billion, 4.3, 4.6, 4.9, 5.1 in 2016. So what do we see? We can see constant growth, right? Which is pretty good for us as investors. Now, if we look at earnings, because sales is sales, right? We're interested more in earnings. Let's have a look also from the very beginning. We can see that was a very good growth here, 50, 65. So it's 30% growth here. It's only 15 cents, but it's 30% growth. Here it's nearly 40% growth. So it's 30% here as well. And then it was growing until 2008. And look at this, from $1.70, it went to 28 cents. So the drop was quite big. Okay, so it's what, nearly 5 times less, okay, of the earnings. So that's what I was telling you, that when the recession is there, hardline industry can suffer quite a lot. Similar situation we saw when we analyzed HR industry, okay, and we looked at companies like recruitment companies, and we saw it as well, that the earnings dropped quite significantly there. Whereas if we analyzed Hershey, remember, Hershey didn't suffer quite a lot. Hershey had about 10 or 15% drop in their earnings because people still eat chocolate. Okay, and some companies, a new skin, I think it's even grew because people look for alternative income and they start joining multi-level marketing companies, and their profitability, that company was growing during the recession time. So that's why it's very important to understand the business cycle for each particular company. So, and after that, look at this growth. It's more than 100% here, more than 100% here. So it's recovered quite quickly. Okay, and then start growing up. Okay, and if we look here, net profit margin, we can see it straight away. So that's why they managed to keep their sales level high, but because they reduced their margin level for nearly less than 1%, okay, they managed to keep company running, and then just by increasing the margin, they significantly increase their profitability. Okay, so that's how companies they were doing. So they just increased their margin. So they put the prices back a bit higher, and that's how their profit start moving up. Okay, without like quite fast, because the earnings here, they're growing much faster than sales. Okay, and we're going to look at this in a second. So we can see what happening here. 71, 220, 180, 220, 250, 280, 320, 337, and look, this year, they expect it to be lower. As I told you, they don't have final report, so we don't know the final number, but the prediction of value line that they're going to have 7 cents less. Now, 7 cents is what? Less than 2%, about 2% of like earnings drop. Now, also, if we look at net profit, let's have a look here. What we can see, it was 310 million, and now it's 295. So it's 15 million less. So it's actually 5% here. So it's 2% here drop, but 5% in the company as a whole. Why? Because they're buying back shares. So the amount of shares is less on the market. So that's why it's the profit per share didn't drop as much as per company as a whole. Now, still it's a good thing that they're buying back shares. It means that they believe that the company is going to go well in the future. All right. Now, but look at this. What happened? The price of the company was $89, and now it's $48. So it's half of what it was in 2015. And the drop happened because their earnings 2% less than before. Now, do you think it's normal? I mean, why? Why? Like, I mean, if you're a business person, and if your revenue and your sales revenue is still growing, but let's say earnings, they drop down 2%, why would your company worth 2 times less? Sometimes it's just purely nonsense. Okay, in this particular case, I believe that it's fear on the market because whole industry sectors, it's pretty volatile company from the price perspective, and people afraid of it. And look at this, if we look at the price level, so for example here 18 and 36, so it's 2 times during the year the price was changed. Here 27 and 45, 50% change. Here 32 and 48, also 50%, 43 and 60, 50%. So it's like during 1 year you can see the fluctuation of the company of about 50%. So it's like if you take 100 to 150, all right? So, and of course, not everyone can handle it psychologically. When you buy, for example, if you're lucky and you bought it at the bottom at 100 and it's went to 150, you're happy. But if you bought it at 150 and start dropping down, believe me, if it went to 100, people are really, really scared at this moment. And even if they understand that there is a business cycle and the company with the next 7 months or whatever, it will go back to 150, still it would be pretty hard to handle it. Okay, and for value investors, it's one of the traits, like personal traits, which you have to be able to handle this type of movements. So that's why value investors, they prefer to have companies with low volatility. But again, so coming back to this level, so you have to understand that the price drop from $90 to 48, it's quite a lot. It's nearly 50%. Now let's go look. Maybe something bad happens in this company. Maybe they have high level of debt. Okay, debt 125 million. Capitalization 4.4 billion. So it's really, really low level of debt. Now let's see how they can handle it, how they can pay. Their profit, net profit last year was 310 million. So it means that 125 million they can pay probably purely from their 5 months earnings. So that's it. And they won't have debt at all. So it would be zero debt. So in this case, there are no problems here. Okay, maybe something else. So, and let's have a look. They're buying back shares. They're paying dividends. Dividends is quite high on the current price. PE is only 14. So let's compare PE previously. What we can see, that if we take whole period from 2000 until now, the lowest PE was in 2010, 15, and in 2012, 15.8. Okay, both of them. At the moment, is 14.5. So historically, this PE is the lowest. Of course, during that time, because it's like average PE at the year. So sometimes during that year, it might go down, it could be higher, right? And at the end, it's finished up. So now we can see that if you compare with average PE, it's much lower. Okay, so it is a good thing for us. So it means that at the moment, people are paying for this company in multiples less than they paid in average during last, what, 17 years, 16 years. Okay, so we have to understand why it's happening. But then we can see that company expects that PE is going to be 18. If company believes that the PE would be 18, even though they keep the same earnings, assuming that they keep same earnings, it has to go nearly 40% up. Okay, like, I mean, maybe 30% up, okay, from 14.5 to 30. So in order to be like this statement has to be true. Okay. So the next thing we look what gross margin. We can see that gross margin a couple of years ago it was 42%, 42.3, and now it's 39.8. So it's actually the lowest gross margin it had for the last from the recession time. Okay, so and then we go back down and we can see that net profit margin 5.8, where it was 6.4 before, 6.6. Some people will think, oh, it's not that much. It's just what, 1 point here, it's not that much. But in reality, if you think about it, if it goes back to the same margin, keeps same volume of sales, but increase the margin by 1% here, it means that their profit will grow 20% up, practically 20%. So if it goes from $5, 5% to 6%, it means that their profit has to go 20%. So it would be here not 3.3, but plus 66 more. So, and of course, it will drive the price down up as well. So that's why it's important to understand that they believe that they're going to move the net profit margin back to 6.5 points. Okay, so that's the thing which we have to keep. Then return on capital and return on share equity is similar here because we don't have debt, like practically don't have debt. So it's 24%. Warren Buffett likes companies with return on equity and capital more than 20. So it's good kind of for us. All right, that's the website of the company. If you decide to go Williams Sonoma, what we can see that it has 635 retail stores, 5 concepts. Here they're listed. Also, they have 8 brand catalogs, again listed, and we can see that 51 is e-commerce and catalog, which is pretty good thing for us. Officers and directors own 2.2% of stock. Okay, and here they show 5 largest shareholders own 31% of the stock, which is pretty good. So 5 shareholders owns 31% of the company. Now, if we, like you look at Signet, which we analyzed last night, it was less than 1% ownership of the company. And we discussed that the more officers and directors own share in the company, the better for us. Okay, and again here it described what I probably told you already about the company, that last year it was kind of like general trading volume in retail industry was low, and that's why the companies kind of fell in prices. Okay, now again let's have a look at the current financial situation. So what we can see. Cash. In 2014, they had 222 million, then 193, and 2006, 75. So it's dropping down. So it's not a good sign. If company has less and less and less cash on their account, we have to ask where the money go. Okay, where the money goes. So if we look at current assets, they drop down. So they had 1,391 million. Then 1,336, and now 1,347. So it's like lowering down. So we have to understand, because it's close to the same level, but here it's like nearly 150 million missing cash. So when cash went, so we can see receivables, 30 million here. Like customers before owned them 67 millions, now 96 millions. And inventory. They had 887 million of inventories. Now they have 1,063. So it's nearly 150, more than 150 millions here as well. Okay, and some others drop down, so less than there. So we can see that inventory growth is not a good sign as well. We have to understand why the inventory they're growing. Now, from that point of view, it's other situation. We can see that current liability they're growing. Okay, and it's account payables. So they buying product, probably they got better deals or whatever, but we can see that their debt level went from 875 million to 1,030. Before the ratio was much better, current assets to current liabilities. Now it's still pretty good. They're still 30% higher in current ratios, but at the same time, we have to understand that for whatever reason, they're trying to postpone the debt payments, right? And they're doing something with cash. Now the question, what do they do with cash? And here probably the answer, they are buying back shares. Okay, they're buying quite a lot of shares, and we can see that at the moment they have still 477 million is available for the letter purpose through 2018. So that's board of director agreed that they buy their own shares back, and that's what they're doing. So they're using cash. And if you think about it, and we go to previous slide, their return on equity is 24%. Okay, so if they manage to negotiate the deals and maybe they are not paying anything for their delayed payment to their suppliers, so why wouldn't they use their cash to get back shares, and it gives additional profit to the company, 24% return on their equity. So that's why probably the fact that they don't have enough cash, like, I mean, the cash is lower, it's maybe a good thing. They keep cash working, not just laying on the account and doing nothing. All right, so, and we can see that they're still profitable, they don't have any risks, and still assets to liabilities ratio is pretty good. So if something happens in the company, they still have more cash than their liabilities. That's the annual rates of earnings. We can see that the sales growth was 10% within the last 5 years, and earnings 27%. So it's quite big, and I showed you that it was doubling within first few years after recession. But they expect now it's only 7 to 8% growth. That's the profit growth. Okay, it's separate from what they expect the price growth. That's the price growth. Value line expect is going to go 27%. That's the earnings of the company, sales and earnings. Okay, here we can see quarterly sales. The interesting thing about it, at the moment they're going to report that quarter. Okay, last quarter, and we can see that each time this quarter shows much better results than previous quarter. So here 1,051 million, 1.4 billion, 1,143 million, 1.5 billion, 1.2, 1.5. We can see every time this quarter is better than previous. And sometimes what I noticed that some investors who don't really pay attention a lot to the company and they just look quarter to quarter growth, they might see, oh my goodness, look at this fantastic growth, and they start buying company. So maybe these earnings, if they're in a kind of they make what they expect, it might drive the price up. Okay, just because some investors, they don't follow the company for quite a while, and they can see that it was 1 billion and 97 million, then 1 billion 150 billion, then 1.2 billion, and now 1.6. They see this growth and they believe, oh, that's cool, I'm going to buy this company. And as a result, what can happen? The price will be driven up, and you can make money if you purchase it before that. Okay, so that's the thing. All right, and we can see here the drop in earnings, 1.55 last year, and they expect 1.5 now. So, and that's why we're missing here. But as I said, we don't have the results. They might as well be better. Why? Because look at this right bottom corner. Earnings predictability 35%. So they're right on the 35% times out of 100. So it means that if they tell you that they're going to make this money, they might be not right. Okay, and it calculates as good and bad results. So they might tell you, oh, we're going to make 100 million, and they made 110 million. It still will be considered bad predictability because they didn't get into the point where they promise you to do. Price growth persistence is pretty good, 85. Stock price stability 55, and we already discussed it, that it moves 50% up and down during every year, and it's not kind of very good for people who kind of stressed out about movements of the stock. Okay, so you have to be prepared for that. Okay, so that's probably all about fundamental of the company. So I have a question for you. Do you think, is it a quality company? Is it undervalued company? Dean's profit margin is a bit small. Ian 4. It's undervalued. Peter, yeah, you're right. So Dean, it's actually a normal thing for this industry. If you look at some companies, they have even lower like net profit margin. So it's kind of, it's all right for that particular industry because it's really, really competitive. That's why they cannot increase the margin, because as soon as they increase the margin, it means that people will go to different companies and start buying from them. Really, really tight business. So that's why a lot of small businesses in that industry, they just close in within the next 1 or 2 years and profitably losing money, because it's really difficult to compete with big businesses like WSM. Okay. So that's what we got based on valuation from TACM. Now, remember, I am not going to put the whole table how we analyze it, because we looked at value line reports, but basically what happens, it gets 44 points in scoring system. If it is above 40, based on their guidance, it's ideal company and get 4 points as like a scoring system. So if it would get into the range 27 to 39, it would be higher range. So it's strong company. Below, it's already bad company, so we're not going to look at them. But this company is actually gets above 40, 44, close to max. So it's pretty good company. I presume it's only losing on the fact that it's not growing like within last year. Okay, that's, you see it's 3, so instead of 4, I put it less, and also growth trend, so it's not growing. So that's why it's missing. The rest of it's max. Okay, here we can see. Now, if we look at trying to identify buy, hold, and sell range using fundamental analysis. So how do we do it? Okay, again, before we start, you can see that it's 52 points. So it's the maximum score is 52, and it gets 52. So it's like maximum which we can get for evaluating company of the buying price. So it's like a perfect based on the TCM guide. Okay, now let's have a look. How do we calculate it in order for you to understand this better? Now, that's maximum prices within last 5 years. Now, it doesn't include 2016 because 2016 is not over yet. So it's 2015, 14, 13, 12, and 11. Okay, so what we can see, that's the highest point and that's the lowest point. And if you look at this 27 to 45, nearly 50% gap, like also here. So it's quite significant movements in price. And that's earnings, which happened during that year. That's how much money company made. So what we did, we calculated averages. So if you add all the maximums and then divide them by 5, you get average high, and that's you get average low, and that's you get average earnings. And what we do after that, we're just trying to figure out, okay, what's the average PE ratio was at the lowest point and at the highest point. So in this case, we kind of get the average low PE ratio. So within the last 5 years, in average, when people are fearful how much they will evaluate company and how much they're willing to pay for this particular company. And that's the number, 15. So it means that at the lowest points, okay, in average low points, people were happy to pay 15 times more than earnings for this particular company. All right, so that's kind of a good sign. So at the moment, remember, we have 14.5. So it's actually below that average. So that's why probably we get here 52 points. Now, what do we do after that? Okay, we assume that the company sometimes in the future has to get to this point, and it's already got it. Okay, so and then what we do, we multiply by current earnings, which we had last year, and last year we had 3.3. So if we do 15.10 multiplied by 3.3, we get 49.84. So we expect that at the lowest level, the price of this particular share has to be about $49. Okay, that's the best, I would say, buying price for us. Now, then we try to identify, okay, what's the maximum? And the maximum is that if the company is performing well, people are happy with that, they're happy to pay 64 divided by 2.8. What we get? 22 times. So PE 22. That was at the highest level. Okay, so in some cases 22.69. So we expect if sometimes in the future company is going to make what they promise, and if we go back to value line report, so we can see here earnings per share, they expect that it's going to grow to $5.25. If they're right, they probably keep the investors happy, and they will be paying higher evaluation level, like higher PE ratio. So it means that sometimes price in the future can be 525 multiplied by 2269. It might be $119 based on the past performance. So the share price might fluctuate between $49 to $119. So what we do, we divide it by 3 areas. So equal areas, assuming that share sometimes will be in this area, then in this area, and then top area. And the bottom area from 49 to 72, it's a buy range. So that's where we consider to buy range. Of course, we're trying to buy at the lowest point. Then we have a hold range, and then we have a sell range. And now if you compare now with the value line reports, look at it's very, very similar, right? So they expected that the share price might go to 115 from 75 to 115. Okay, based on our calculation, from would say 96 went to 190. Okay, 72 it would be the point where we stopped buying it. Now, at the moment the price is below that, so 48.5. Okay, so it's below that lowest level. And usually what I do here, I calculate the reward to risk ratio. And for example, if the share price was $50, $55, I would say, okay, we have $6 or $5 risk of falling to this lowest point, but we have from $55 to $119, so it's $65 growth. So, and then I will divide 5 and 65, and you can see that, okay, it's nearly 15, like what, 13 times higher reward, potential of reward than risk. Okay, and that's a good thing. We're trying to find companies which have 3 times higher reward compared with risks. At the moment, it's negative. I mean, it has to be negative because, I mean, we're already below this lowest point. Okay, but again, don't think it's like mathematical science. In a low period of time, price driven always by emotions and by market kind of, I mean, perception of people about this company. In the long term, always by fundamentals. Okay, so we looked at the ETF, we looked at the index in general, and we could see that index might go down. And if index Dow Jones, S&P 500 will go down and the ETF will go down, you might see that this company will drop even more in price. Okay, and you will have even better opportunity to buy than right now. Okay, for this particular moment. So book value of this company $14, and it's actually tangible book value. So and their earnings will be 15th of March. So be careful about that. So because earnings are always, so look at companies in similar industry, how they report their earnings before in order to judge what might happen here. Okay, guys, the question, would you buy this company? So it's pretty good, right? Looks very, very good. So what do we do after we analyze fundamentally? What's the next step? Right. So, yeah. So let's go to technical analysis.